Hey guys, my name is Jose, and this is another episode of Buy or Pass. In this series, I will look at the financial documents of a company and decide if I had money, would I buy or would I pass. Before we start, don't forget to subscribe to get info on new episodes and other videos. So let's begin. So, like always, I'm going to use the website known as lazyfa.com, which allows me to see all these financial numbers in an easy visual format. So today we're going to take a look at Microsoft. So we're going to take a look at Microsoft, and looking at Microsoft, we're going to look at the income statement, balance sheet, cash flow. We're going to take a look at mainly the annual data, but we're also going to take turns looking at the quarterly data. Right now we're on the income statement, and we see revenue right here has been a steady increase. 15 to 16 there was a little slack, but 17 to 18 has increased from 96.57 billion to 110 billion. Unfortunately, cost of revenue is also increasing at a similar slope to revenue. Last year, cost of revenue was 34.26 billion. This year was 38.35 billion, an increase of about $4 billion. Where revenue increased as well by, we can see 96 to 110, about $14 billion. We can see here gross profit has increased. This past year, gross profit was 72 billion for Microsoft, when last year was 62.3. So an increase of about $10 billion, over 10%. Another thing we like to see here in the income statement is the net income. So the net income is the cash this company collects after everything's been paid off. We like to see this a positive. Here we have a positive net income of $16.57 billion for this year. Last year it was higher, and so was the year before. To really find out why the net income decreased this past year dramatically, we will have to see more in the earnings call to understand what happened there. But as looking at the numbers right now, net income going down is definitely not a good thing. Earnings per basic share depends on the net income, so we would also see that drop down. Next year, Lazy FA allows us to see something which they call lazy flag, not lazy flag. They let see red flag analysis, which is just another way to view what we just saw, and it has some extra data that I'm going to show you guys. So here we're going to see again revenue versus cost. We can see revenue is always out matching cost, and that's why we have such a positive gross profit. If we take a look at the quarterly data, again, we don't see anything crazy happening in the quarterly data. Pretty steady increase, decrease, increase, decrease, increase in revenue. And cost of revenue also same. Nothing looks outrageous. Nothing is showing me that something crazy is happening. So it's good to see annual data, revenue increasing and cost increasing, but not overpowering revenue. Here we can also see revenue versus cost growth. This is more of a percentage base. Great to see here that revenue growth seems to be higher than cost of revenue a majority of the time in the last 2 years. So last year revenue growth was 6%, cost of revenue was 4.5%. This year revenue growth was 14.28%. That's a really nice double digits, where cost of revenue was 12%. Again, that's also double digits. It seems to be close to almost a 1-to-1 ratio in the past 2 years. Next, let's continue looking down here. Gross margin, profit margin. Again, we can see that profit margin decreasing this past year, which would include why we had a lower net income. This year the profit margins are not as high as they were. This is something we would have to see in the earnings call, which I'll probably do another video on Microsoft's earning call to really dig into what's happening. But seeing that profit margin drop is definitely not a good thing to see. Here in the red flags, Lazy FA has made it super easy to see anything outrageous happening. If it's green, it means everything is going good. If it's red, it means something is throwing a flag. We're going to take a look at right now, average cost growth outweighs average revenue growth. So this flag just shows us that cost revenue is growing at a faster rate than revenue growth. So here this flag was happening from the earlier years, from 2011, 2012, 2013, 2014, 2015, when cost of revenue growth was dramatically higher than the revenue growth. The past 3 years, that has not been the case. Revenue growth is higher than cost of revenue growth. So right now this flag is just showing past data. It's not, I wouldn't really, so this is what I like about lazy FA, right? It just gives me something to take a look at, but after looking at it, it's not something I would consider bad right now, right? Especially since the last 2 years, revenue growth has increased cost of revenue. So taking a look at the income statement right now, nothing outrageous. Definitely not a buy or sell for me at the moment. Let's take a look now at the balance sheet. So here in the balance sheet, these are the main things. Obviously, there's many more things you can take a look at, but for me, total assets, total liabilities, that cash equivalents are the things I like to see the most. So your total assets, again, haven't been increasing. From 17 was $250 billion of assets, where 18 was 258, an increase of 8 billion. Unfortunately, total liabilities have been increasing as well, and it seems to be increasing at a percentage-wise faster. Last year, total liabilities was 162 billion. This year was 176. That's an increase of about $14 billion in liabilities, where assets only grew $8 billion last year. We're going to take a look at total debt now. One good thing to see though is that compared to 17 has been paid off from $91.57 billion last year to $81.8 billion. So I like to see total debt being paid off, and that's a nice amount of chunk. That's roughly about 10% being paid off of total debt. Cash and cash equivalents. This company, I laugh just because this company has a lot of cash. It definitely doesn't have as much cash and cash equivalents as Apple, but it's definitely up there. Right now it's sitting at $133.77 billion. Last year was 132.98, an increase of about $0.7 billion. Not much increase from last year, but this company has healthy amount of cash and cash equivalents. In perspective, this company can pay off its total debt and still have over $50 billion of cash ready to go. So that's really good to see in its cash and cash equivalents. For those that don't know, cash and cash equivalents, right? It's cash or any assets the company can liquidize pretty fast to make cash out of it. Next, again, we're going to take a look at red flags here in the balance sheet. We're going to take a look again, just a different way to see what we just saw. We'll take an annual look at the assets versus liabilities. Here we see assets overpowering, which means we have a positive shareholder equity. Right now, shareholder equity is about 82.72. Unfortunately, it dropped from last year, which was 87.71. So a decrease of about $5 billion of shareholder equity. Main reason doing that, total assets did not increase as much this past year compared to the liability increase. So again, assets this past year only increased by $8 billion, where liabilities increased by over $12 billion. Let's just take a look at quarterly data. Again, quarterly data doesn't show anything outrageous. Everything looks pretty in line with each other. We just try to look for any outliers in the quarterly data, but nothing here shows us anything crazy happening. Here we can see percentage wise of assets versus liability growth. It does seem most of the time, last year total assets grew 29%, 29.3%, where liabilities grew 33.8%. So last year assets was growing at a slower rate compared to liabilities. This year, same thing happened at a much lower rate. Assets grew 3.4%, liabilities grew 8.3%. That's definitely not good to see that assets are not growing as quick as liabilities, and I'm pretty sure we're going to see some red flags thrown out once we keep looking um, further below. I like looking here at asset distribution to seeing what most of the company's assets is. And here, this is really great to see. We're taking a look right now at assets for this past year. Over 54% of the assets is cash and cash equivalents. That's really good to see. I usually don't see many companies having this high percentage being this cash and cash equivalents. Most of the time, I see property, plant, equipment, and those heavy items being a good portion of its assets. And here we have such a huge portion of his cash and cash equivalents being 54.6, almost 55% of the assets. Next, we have the next big hitter is kind of tied between property, plants, and equipment being $36.15 billion, about 14-15%. Receivables about 10%. And here we can see just the amount of how cash and cash equivalents has been increasing from its past few years. Just to take in perspective, in early 2015, cash and cash equivalents was 85.7 billion. 4 years later, it's at 133 billion, an increase of about $50 billion in just 5 years. That's really great to see. Now let's take a look at its liability distribution. We can see a majority of its liability distribution is non-current debt, and there was a huge jump in debt from last year. 2 years ago, it increased dramatically from in December of 2016, so early 2017, it increased from 40.56 to early 2018, $81.4 billion. An increase, it doubled its non-current debt in 1 year, and that's pretty scary thing to see. But again, this company has such enough cash and cash equivalents to be able to pay this off. So non-current debt at the moment is 77.8 billion. Last year it paid off about $3 billion. That's good to see. Current debt for those that don't know is debt that needs to be paid off in the next 12 months, where non-current debt is debt that doesn't need to be paid off within this year. Current debt, so debt that needs to be paid off this year, is only $4 billion. Again, this company has way enough cash and cash equivalents to pay this off. For this company, that should be chump change. So 50% of its liability is due to non-current debt. The next big item here are deferred revenue and tax liabilities. So here, the only red flag is that same red flag that we got next to the income statement. So here in the asset statement, in the balance sheet, we're getting a red flag, which is just telling us that liability growth is increasing at a higher rate than total assets growth. The thing is, that's just percentage wise. If we look at numbers, total assets are still dramatically higher than total liability. So again, a good thing that Lazy FA just lets us know that this flag is being triggered, but in reality, to me, it doesn't really, for this stock in general, it doesn't really help out, because I can see perfectly that total assets and total liabilities are still far apart. If they were a lot closer to each other, that would definitely be a flag I would take a look at. Finally, let's take a look at cash flow statement. So in cash flow statement, the only thing I'm really curious about here is net cash flow from its operations. So this is cash flow that it collects from its everyday operating use. So obviously I want this company to be making money then. And right here we have about $43.8 billion of net cash flow from operations, an increase every year since 2015. Last year was 39.5, so an increase of about $4 billion, give or take, a nice 10% increase in net cash flow from operations year to year. Let's take a look again in red flags for cash flow statements, see if we see anything. The only one, like I mentioned, right here we have, I just really want to see if any flags were triggering. No flags are triggering here. And like I said, the only one I really care for in the cash flow statement is net cash flow from operations. All right, so we're going to do a quick overview. So in the income statement, right, revenue has been increasing dramatically. That's good. Cost of revenue has been increasing. That's normal to see, but it's still good that gross profit has increased. So that means revenue is growing number-wise faster than higher than cost of revenue. So we had a higher gross profit compared to last year. So that's good. Net income, though, this is the two tricky things: net incomes and earnings per basic share. They're kind of mutually together. Here we can see in 2017 net income was 25.5 billion and 2018 was 16.57 billion dollars, a decrease of almost $9 billion. So that's pretty scary to see. If we take a look at net income just in the annual data, this would be bad. Let's take a look real quick at the quarterly data to see if anything outrageous happened in one of the quarters. And here we can see in quarter one of 2018, there was a net income of negative $6.3 billion, which definitely took a toll on what happened, on why we see that huge decrease in net income for 2018. So it does seem like it was a one-time thing. I don't know. I would have to look at the earnings transcripts to see, maybe that might be the new tax law happened during that time, which a lot of companies reported negative net income during those times. So here we see a negative $6.3 billion of net income. But if we take a look at the following quarters, everything looks in line with this. So net income, even though annually looks bad, quarterly shows that it was a one-time thing. So this would still be good for me. Earnings per basic share, I'm assuming we're going to see the same thing. And yep, here, quarter one of 2018, we had a negative 82 cents of earnings per basic share. But after the quarter, we've seen an increase in earnings per basic share. So to me, the income statement gives me a pass. Balance sheet, nothing outrageous here to see. Assets increasing, liabilities increasing, total debt increasing, but being paid off, and cash equivalents at such a huge level. Let's just take a look at quarterly to see if we see any outliers. In total assets, we don't see anything. Total liabilities, nothing. Total debt, we've seen it's getting paid off. Good to see. And cash equivalents, quarter, again, I'm assuming it's using this cash and cash equivalents to pay off this total debt. So it's not bad to see some decrease in this. Balance sheet, also looking good. Next, we take a look at cash flow from statement. Overall, last year there was a increase in cash flow, and here in quarter we can see that this is fine. Q1 of last year and Q1 that was just reported are usually lower. It seems to be some form of cycle where the first quarter always seems to show lower revenues. I'm guessing it's a season thing. So again, nothing crazy for net cash flow. Metrics, we'll take a look at price to earnings ratio. This year it shows price to earning ratio of 45, pretty high, but again, it was due to the previous quarter deficit. But here we go. Back in this quarter, we have about 23.34 price to earning ratio, which is in line with everything else. So to me, Microsoft would get a buy. I hope you guys enjoyed the episode. Like I mentioned, lazyfa.com makes it so easy to look at all the information, which makes these episodes go pretty fast. I'm curious, would you buy or pass on Microsoft based on the information we just saw? Also, again, don't forget to subscribe to get updates on new videos, and see you guys next time. Have a good night.